Welcome back to the Deep Dive, where we conduct critical financial investigations to define the risk before we look at the reward. Today, we're diving into Fair Isaac Corporation, better known as FICO.
hmm
This isn't just about a credit score, it's about the central nervous system of consumer finance, a company defined by structural dominance and accelerating technological transformation.
And that duality is exactly what makes FICO such a compelling yet complex deep dive. You have the decades-old, high-margin sticky scores segment, which is essentially a mandatory regulatory utility in American finance.
Right.
And then you have the software platform, which is pivoting quickly toward focused AI and acting aggressively like a pure-play, high-growth tech disruptor. The tension between these two businesses, regulated utility versus high-tech innovation, that really defines the company's future.
Okay, let's unpack this. FICO is betting its durable scores moat, demonstrated by its use in 98.8% of U.S. securitizations, and the accelerating high-margin growth of its FICO platform will drive 18% revenue growth to $2.35 billion in FY 2026, justifying its premium valuation despite intensifying FHFA regulatory scrutiny and the existential risk of customer concentration.
Yeah, that thesis immediately puts the focus on the company's just its unique ability to generate cash.
It does.
It really does. We have to start with the profit engine, which is and will remain for the foreseeable future, the scores business. This segment is the foundation of FICO's financial stability, driving just unparalleled profitability.
The financials here are so unusual for a publicly traded company, they really require specific attention.
They really do.
When we look at the core numbers, the strength is just immediately apparent. In Q3 2025 alone, Scores revenue hit $324.3 million.
And that's a robust 34% increase year over year.
34%. And looking at the full picture, FY 2025 Scores revenues reached $1.169 billion. That's up 27% year over year. But the revenue growth, while it's impressive, that's not the whole story, is it?
No, not at all. It's the cost structure, or the lack thereof, that defines this business model. Once the algorithm is built, tested, and approved, the marginal cost of producing one additional score is almost zero.
Right.
This leads to the truly critical metric, the operating margin. FICO Scores segment operating margin is consistently around 88%.
88%.
Yeah, Q3 2025 clocked in at 87.8%. You are essentially looking at a revenue stream that requires almost no additional operational expenditure year after year.
That kind of margin doesn't happen just because you have a popular product. I mean, it screams structural advantage and regulatory entrenchment. FICO doesn't have a moat. It has a fortress built into the financial bedrock.
It does.
What exactly is the mechanism that allows them to maintain that dominance, even against viable competitors?
The secret is securitization. FICO scores aren't merely used by lenders to decide whether to issue a loan. They are structurally embedded as the common language and benchmark for credit quality in the financial markets, specifically in asset-backed securities or ABS.
Okay, so let's elaborate on that for the listener. When a lender originates thousands of mortgages or auto loans, they don't just hold them on their books forever. They bundle them up and sell them off as securities to investors globally. That's securitization.
Precisely. And for a global investor to buy a piece of that bundle, a mortgage-backed security, for example, they need an instant, globally recognized, and legally durable measure of the risk in those loans.
A common language.
A common language. FICO scores provide that trusted, uniform standard, and our sources confirm this dominance. 98.8% of U.S. securitizations solely cite FICO scores.
Almost total capture.
It's almost total capture of the most important financial mechanism for liquidity in the housing and consumer markets.
So this isn't just about consumer preference. This is financial plumbing. If FICO scores weren't used, the whole process of pricing those assets would just become chaotic, and risk transfer would grind to a halt.
It would.
And classic FICO, the previous generation score, has been the unquestioned standard for over 20 years in the conforming mortgage market. I mean, that institutional inertia is incredibly powerful.
It is the ultimate barrier to entry, but it also generates legal exposure. When you achieve that level of control over a critical market utility, you inevitably attract scrutiny.
Sure.
And we should note the ongoing legal risk here. FICO is involved in a putative class action lawsuit regarding antitrust claims, specifically a Sherman Act Section 2 claim, alleging illegal monopolization.
And while that legal challenge is kind of a background hum, FICO leadership has successfully leveraged this market dominance to execute a really aggressive and highly profitable pricing strategy.
Yes, and this is the crux of the investment case. Management's long-term strategic goal is very open about aiming to close the, and I'm quoting here, very large value gap between what we charge and the value that the score provides.
Think about that statement. They know their product is underpriced relative to the millions, maybe billions of dollars in risk mitigation it provides, and their whole goal is to capture that value through pricing.
It's a pure value-based pricing strategy.
The history here is just stunning evidence of their pricing power. I mean, consider the mortgage space. The price per score pull has increased from what, roughly 60 cents in 2018?
Yeah, around there.
To a staggering $4.95 today. That is an exponential increase in just 6 years.
It is.
How do lenders absorb that kind of increase without just protesting or switching immediately?
Because the alternative, switching to a score model that is less trusted in the securitization market, is catastrophic.
Yeah.
The cost of a loan going into default is so much higher than the 4.95 cents per pull. So while 4.95 sounds high for a data query, the value it unlocks or the risk it mitigates is vastly greater.
So it's still a bargain, in their eyes.
It allows FICO to execute what they term a predictable, methodical approach to price hikes.
And it's not isolated to mortgages. I mean, overall, B2B revenues saw a massive 52% year-over-year price increase in Q4 2025.
Right. And even in less headline-grabbing areas like auto and personal loans, they consistently apply cost of living, inflation-oriented adjustments. It's just a testament to the essential nature of their service.
But FICO can't rely purely on regulatory inertia. They have to demonstrate that their score remains technologically superior. This is where their ongoing innovation plays a defensive role, primarily through FICO Score 10T.
Exactly.
So what's the practical difference between the older classic FICO and the new 10T? Why does it matter to a lender?
Well, classic FICO largely uses a snapshot of a consumer's credit history. FICO Score 10T incorporates trended data.
Trended data.
So it looks at how the consumer is managing their debt over time. Are they reducing revolving balances month over month, or are they just meeting minimum payments? This insight provides really significant improvements in predictive accuracy.
And the performance claims really confirm this differentiation. FICO states that Score 10T detects 18% more defaulters in that critical score decile compared to its main competitor, VantageScore 4.0.
And that 18% difference is not an academic statistic. That is a hard dollar difference in realized loan losses for a lender.
Absolutely.
Exactly. And we see real-world validation of the superiority, particularly in the non-conforming market. So the segment not rigidly governed by government mandates. Lenders representing over $300 billion in annual mortgage originations.
$300 billion.
And $1.5 trillion in mortgage servicing portfolios have already adopted 10T. This signals that when the market is free to choose the best predictive model, it often chooses FICO.
It also demonstrates FICO's ability to adapt. They aren't just sitting on the $4.95 score, they are modernizing it. We see this with innovations like FICO Score 10 BNPL, which tries to incorporate buy now, pay later data.
And the FICO Resilience Index, which is designed to identify consumers who are resilient to economic stress, which helps promote financial inclusion without sacrificing risk quality.
So, to summarize this first pillar, FICO has a foundation built on an 88% margin, protected by this structural moat in securitization, and it's actively defended by continuous innovation like Score 10T, all while they're aggressively hiking prices.
That's it. And that sets the stage perfectly for the second pillar, the FICO Platform and their focused AI strategy. We're transitioning from the low-growth, high-margin utility to the high-growth, lower-margin investment segment.
And the contrast is really stark.
It is. The software segment's Q3 2025 revenue was $212.1 million. But its operating margin was only 32%.
Only 32%.
And that 32% margin, while healthy by any normal software standard, is proof that FICO is heavily investing in this segment. They're prioritizing market share and expansion over immediate profitability.
The strategic focus here is entirely on the FICO platform, and it's not just a collection of software tools. It's designed to be an operating system for financial decisions, intended to orchestrate and operationalize high-velocity decisions that matter at scale.
Right. We're talking about real-time fraud detection, customer management, origination processing, all running through this one architecture.
Their market penetration strategy is a classic and effective land and expand model.
It is. They aim to penetrate roughly half of the top 300 financial institutions globally. They land a core product, and then they expand its usage across different business lines, from checking accounts to auto loans, driving revenue expansion organically within that existing customer base.
And we can see this strategy bearing fruit in the financial momentum metrics. Platform ARR, annual recurring revenue, reached $263 million in Q4 2025. That's already 35% of their total software ARR.
Yeah,
But the definitive indicator of the platform's success is the net retention rate.
absolutely. The platform NRR sits at a very strong 112% in Q4 2025. For the listener, this means that the average existing platform customer is spending 12% more with FICO this year than they did last year.
Which is a huge sign of health.
It's critically important, especially when you contrast it with the non-platform NRR, which is stalled at 97%. That 112% is the hallmark of a healthy, successful expansion strategy.
And this momentum is translating directly into new, committed business. Q4 ACV annual contract value bookings were $32.7 million.
Which was their best quarterly ACV performance in 6 years, totaling $102 million annually. The platform is finally gaining significant traction.
This is where we pivot to FICO's technological differentiator, their specialized AI strategy. FICO explicitly draws a bright line. AI and machine learning are used heavily in software, but conspicuously not in the regulated scores business.
And that distinction is vital.
So why the separation?
Because of the regulatory needs for transparency and auditability in the scores segment, regulators require explainable logic. As FICO's leadership has noted, AI models, particularly modern machine learning, are often seen as a black box by regulators.
Right. You can't explain why it made the decision it did.
Exactly. And that's just not palatable for mission-critical tasks like credit scoring, where every decision has to be traceable and defendable.
But on the software side, where they're dealing with real-time optimization, marketing, fraud detection, they're free to accelerate. And this is where their cutting-edge generative AI strategy comes into play.
Right. They are not pursuing some generalized large language model. Instead, they are focused on building a domain-specific GenAI model called the FICO Focused Foundation Model, or FFM.
And it's tailored exclusively for financial services risk management.
That domain-specific focus is key to their extraordinary claims of efficiency.
Okay, let's talk about those claims because they sound almost unbelievable. The FFN claims to provide a more than 35% lift in fraud detection models while using 1,000 times fewer resources. How do we even interpret those numbers?
Well, the lift means significantly reduced false positives and more successful fraud detection, which saves financial institutions massive amounts of money. The 1,000 times fewer resources claim, that speaks to computational efficiency.
So it's cheaper to run.
Much cheaper. By training the models specifically on those structured, high-quality data relevant only to financial services, they avoid the huge computational overhead required by general models. It means faster deployment, lower operating costs, and quicker time to value for the customer.
So given that they know the regulators require explainability in scores, how does FICO manage to bring that kind of highly predictive ML power to the market in the software platform without running into the same transparency issues?
They use this really clever two-phase development strategy that explicitly bridges the gap between performance and palatability.
Okay.
Phase 1. They rapidly develop the absolute best predictive ML-only model in the lab. This maximizes the performance lift. Then, Phase 2. They then closely approximate that predictive power with a system of highly segmented, auditable scorecards.
So they use the black box AI to find the best possible answer, and then they reverse engineer a transparent, explainable path to get to that answer using traditional logic.
Exactly. The domain experts impose constraints on the process to ensure the final deployed model is fully explainable and auditable, even if it means sacrificing maybe 1 or 2% of the theoretical maximum power of the pure ML model.
It's a pragmatic and powerful approach to innovation. They are going as fast as they can where they are allowed to, and using their sophisticated tech to find regulatory compliant answers where they aren't.
Correct. The software platform is the future growth engine, balancing cutting-edge AI with the financial sector's intense need for reliability and auditability.
All right, let's transition now to the third pillar, financial resilience and capital return. All this structural dominance and tech momentum translates into a strong forward-looking outlook.
Yeah, even in a cautious macro environment,
Yeah.
the FY 2026 guidance is robust. Management assumes no significant macroeconomic improvement or material change in market share.
Right.
Yet they project $2.35 billion in total revenue. That's an 18% increase year over year.
And that growth is really a reflection of the score's pricing strategy continuing to execute, combined with that accelerating platform growth we just discussed.
It is. And the bottom line looks even stronger. They are guiding for $33.47 GAAP diluted EPS, which would be a 26% increase year over year, and $38.17 on a non-GAAP basis.
And this high growth profile is underpinned by the immense amount of cash the Scores segment generates.
Cash engine strength is undeniable. FICO delivered a record annual free cash flow, or FCF, of $739 million. And this metric is the lifeblood of the company, especially given a peculiar structural element on their balance sheet. FICO technically operates with a negative tangible net worth.
Wait, negative tangible net worth? That sounds bad. For the listener, what does that mean, and why is that FCF generation so critical in that context?
It's a strange one, right? It means that if you subtract all of their liabilities and all of their intangible assets like goodwill and brand value from their total assets, the number is negative.
How does that happen?
It's largely a result of decades of aggressive, calculated debt-funded share repurchases. They prioritize returning capital to shareholders through buybacks rather than holding that cash on the balance sheet.
So that's why the consistent generation of $739 million in FCF is absolutely essential.
It's essential to service their debt, maintain liquidity, and continue their capital return program without disruption.
And share repurchases are undeniably their primary capital return strategy. They view buybacks as the most attractive use of cash.
They do. They're targeting spending their free cash flow to buy back shares while maintaining a healthy leverage level, typically between 2x and 3x total debt to EBITDA.
And this strategy drives EPS growth by reducing the share count. In Q3 2025 alone, they bought back 284,000 shares at a high average price of $8,802 per share,
which signals immense confidence in the future valuation. And to cement this, the board approved a new $1.0 billion open-ended stock repurchase program. It's a clear communication to the market. FICO's growth will be driven not just by revenue, but by equity compression.
And they remain responsible with their balance sheet management. Total debt was $2.2 billion as of September 30, 2024. They're comfortably within their compliance range, reporting a 2.38x leverage ratio against a max covenant of 3.5.
The financial engine is operating at peak performance, demonstrating exceptional cash generation and aggressive shareholder return.
Yeah.
However, this high profitability and pricing strategy has directly created the existential threat that we need to talk about next.
That brings us to the biggest external headwind and the most critical risk factor: regulatory intervention and pricing risk, primarily originating from the Federal Housing Finance Agency, or FHFA.
This is the critical battleground for FICO's Scores Moat. The FHFA, which oversees Fannie Mae and Freddie Mac, the massive government-sponsored enterprises that back the mortgage market, has introduced huge regulatory challenges. They have approved competitor scores,
VantageScore 4.0.
specifically VantageScore 4.0, and are actively moving toward a lender choice model.
What exactly does lender choice entail, and why is it such a threat to FICO's dominance?
Historically, the GSEs mandated the use of FICO scores. Under lender choice, lenders will be allowed to pick between using FICO or using VantageScore for conforming mortgages. Crucially, they still must use the tri-merge reporting system.
Okay, let's just clarify the tri-merge system.
The tri-merge system refers to the lender getting credit info from all three major consumer reporting agencies, TransUnion, Equifax, and Experian, all at the same time.
Right.
And for a long time, FICO's distribution model was tied to this system, which created a complicated pricing structure. The FHFA mandate aims to introduce competition into this process.
And the political context is that this is all driven by concerns over FICO's long-standing monopoly pricing and a broader policy push for more inclusive scoring models.
FICO's direct countermeasure to this regulatory shift is their newly announced FICO Mortgage Direct License Program. It's a strategic move to decouple themselves a bit from that tri-merge pricing structure.
And they're introducing optionality on pricing, too, offering the historical per-score model alongside a new performance pricing model,
which essentially tells the FHFA that FICO is willing to compete on quality and successful outcomes rather than relying purely on the old monopolistic structure.
However, FICO also has to navigate a substantial business risk inherent in their reliance on the existing infrastructure. We have to talk about customer concentration risk.
It's huge. The three major consumer reporting agencies, TransUnion, Equifax, and Experian, accounted for 45% of FICO's total revenues in fiscal 2024.
45%. And within the scores segment specifically,
it's even higher. It accounted for 54% of revenue in Q3 2025.
That concentration is an existential risk. If one or all of the credit bureaus, facing pressure from VantageScore, decided to aggressively promote the competitor score, FICO would lose nearly half its total revenue overnight.
It gives the bureaus immense leverage. And this is why FICO CEO Will Lansing has gone on the offensive, issuing a strong public warning about the systemic consequences of this lender choice model.
Right. He argues that this system creates an incentive for a race to the bottom.
A race to the bottom for the most lenient score, posing a significant risk to the safety and soundness of the financial system.
So let's dissect that argument. If lenders can choose the score that rates consumers higher, the laxest score, they can originate more loans and earn more fees.
And FICO argues that this creates unavoidable gaming and adverse selection for all risk holders.
So is FICO genuinely sounding the alarm on systemic risk, or is this just a well-calculated defense of their monopoly pricing?
It's likely both, but the argument does have teeth in the GSE context. Since the GSEs, Fannie and Freddie guarantee these mortgages, if lenders shop for the laxest score, the overall credit quality of the system declines, and taxpayers are ultimately exposed to higher risk.
That brings us to the ultimate financial risk here. The potential for regulators to just cap FICO's pricing power. They've had this aggressive value-based pricing strategy resulting in that $4.95 price tag. What happens if regulators look at that and decide to cap future increases?
The fear is a cap on score prices, potentially modeled after companies like VeriSign, where price increases are limited to an established annual rate. If regulators focused on consumer affordability decide to limit future price increases in the profitable mortgage market, it would fundamentally challenge the valuation.
Because FICO's valuation is explicitly premised on the continued success of closing that a very large value gap. If the government mandates that the gap cannot be closed, the projected 18% revenue growth and margin expansion just evaporates.
Exactly. So we have FICO, a dual entity. One side is an invincible profit machine that is now under serious regulatory threat because of its success. The other is a high-growth, innovative software platform trying to justify the whole valuation.
We've reached the final pillar. Let's synthesize this complex picture and deliver the final verdict on the structural risks versus the performance.
FICO is undeniably an exceptional financial performer. You've got a high-margin, sticky core business and accelerating software growth, targeting 18% revenue growth for FY 2026. The performance metrics, the 88% margin, the 112% NRR, the $739 million FCF, all speak to a company executing at an extremely high level.
However, the market has certainly noticed. The stock is undoubtedly priced for perfection, trading at a forward PE of 47.99x. When you compare this to software peers, even those with higher revenue growth rates, FICO is the most expensive on a price-to-operating cash flow basis.
That premium valuation relies entirely on two high-stakes assumptions. First, that the score segment maintains its pricing power and structural dominance.
Successfully defending its position against the FHFA's lender choice model.
And second, that the platform segment continues its strong momentum and eventually contributes materially to margin expansion.
Therefore, the regulatory risk, the FHFA shift, and the potential for a pricing cap in that high-margin mortgage segment, that represents the main external threat that could limit the future revenue expansion FICO is counting on.
The investment case is fundamentally a high-risk bet on flawless commercial execution in the software segment, and FICO's ability to maintain its pricing power and structural dominance. The tension is high, and the stakes are immense.
What's fascinating here is that FICO is accelerating innovation with its AI platform, precisely where regulators allow transparency to be a black box, while defending its regulated scores business, where transparency is paramount. The question is, which side of the business, the heavily regulated utility or the high-velocity software disruptor, will define FICO's valuation over the next 3 years?
That fundamental conflict, balancing mandated transparency with cutting-edge commercial innovation, is FICO's ultimate challenge.
Risk defined, portfolio protected.